What if I told you one of my mortgage broker clients doubled their income in just 90 days and didn't bring in a single extra lead to do it? There's no gimmicks, no ads, just complete overhaul of how they ran their sales calls, pitch protection, and position themselves as a premium advisor. So in this episode, I'm breaking down exactly what changed and how you can apply the same strategy to increase your income without increasing your workload as a mortgage broker. Let's dive into it. So welcome to the Mortgage Business Mastery Podcast, the show that helps mortgage brokers simplify success. My name's Ash Borland. If it's the first time we're meeting, whether you're watching this or listen to it wherever, please do subscribe. And today, like I said, in this episode, we're going to be talking about a real life situation with my clients, and it's a story about how to work smarter, not harder. And I think many of you who listen to this show, who tune in on Spotify, on Apple, or if you're watching it on YouTube, some of you will resonate with this situation, and hopefully you're going to be able to implement some of the stuff we talk about today. And I'm going to kind of talk through this specific client's story. The idea is this: a concept of brokers think that they need more leads to grow their income, and actually they don't. And this specific client that I'm going to talk about today, they actually more than doubled. I say doubled in the more than doubled their average income over a 90-day period. Now, the broker in this question, for example, so when we first started working together, they were averaging around $9,000 a month, which is a decent broker. So some of you be out there have been working for about 4 years, an advisor. They're doing about 9,000. Some months maybe 10 and 12. Some might be 6 or 7, but they're averaging at around £9,000, which is great. But with all of the stuff we implemented, they actually got their averaging now around £21,000 per month. And that took like 3 months, 90 days to get that in place. So it is very real. And the reason why I share this stuff is that these income levels, we hear this with advisors, is that of course you want to hit this 6-figure mark, but the great thing about mortgage brokers, I think anyway, about the career that you're in, is that there is incredible opportunity to make multiple 6 figures if you get your systems, your processes, and everything else right. And that's what we're going to share this story within this episode. Hopefully you're going to be able to do the same with that. So let's talk a bit about where they were before we started coaching and where they were kind of stuck. So the first thing was they were busy but broke. So they had loads of leads, low conversions, and poor protection uptake. They specifically were generating leads through referrals, and were getting a few leads from introducers. Those introducers were estate agents. And they low conversions, what I always call with these, they're high urgency and low trust. Lead traditionally is, especially from an estate agent, high urgency, they need something done now, and they have low trust. They had a poor protection uptake. The reason they had a poor protection uptake was because, in their own words, they said that they saw protection as an afterthought. When we had our sessions, they were saying, to be honest, hand on heart, it is a bit of an afterthought. And often I skip it altogether, especially if the client might say no, and a fear of losing the mortgage. Now, £9,000 a month for mortgages, that's a decent amount. And there's some fees in there, and their fees were pretty good, and they wasn't awful. So they're making some decent income there, but the protection stuff, they were barely doing any. I mean, it's crazy how much they were doing. And I think this is common. This is a common situation. Now, the other thing we identified within this was that they had no structure to their sales calls. There was no structure at all. They were genuinely just going with the flow, which is a nice way of saying just winging it. There really wasn't any structure behind any of it. Some calls were on the phone, some were on Zoom, some were 20 minutes, some were 10 minutes, some were an hour. There was literally no thing. And what they were doing very much was constantly reacting, firefighting with the client. So they ended up working weekends, the evenings, all that type of stuff. And what they were doing though, is because of that, it was hard to build anything. Okay. Why is this a problem? Well, the core problems that I can see with this is going to be very hard if you've got no consistent structure across your discovery call, submission call, which you should have. You should have a 2-appointment process minimum. I think 2 appointments is fine. 3 is okay, but 2 is best. But no, the core problem there is if they don't know and there's no structure behind it, how can you improve? There's no way you're going to be able to increase your income. This is going to be like a bit of a mix of me telling you what you can do and what they can do. There's no way they were going to be able to increase your income if we don't know what actually works and what doesn't work. If you don't know what's working, you will end up stuck because you're like, I think this works. And then you will think you're better than you are, or you might think you're worse than you are. And usually you'll think you're better than you are most of the time. So there was no structure. So it's very hard to diagnose the problem with that. Now, the problem with that is there's no structure. Fees were being waived too often out of fear. So that was a big one as well. So because they were working with the estate agency, and I said earlier they have good fees, but when they were working with those introducers, those fees were getting waived. They were getting waived quite quickly, actually. And they were worried about other brokers. And that's a big problem. If you're worried about what your competitors are doing, for example, this specific person, well, we were having a chat with this and I was saying like, well, do you have an issue? Where's that fear come from? Like they said, oh, my competitor doesn't charge. I said, well, did the client say that? No. Did they bring up the competitor? No. Okay, then why are you worried? You shouldn't be worried about it. You shouldn't be fearful about it. The protection was pitched too late, which I said already, and this is a massive problem. If it is too late after the mortgage is already done, this is going to be a significant issue, because when it's pitched late, then they've already got what they want. They've got the mortgage, and the mortgage is what they're after. At the end of the day, they come to you for a mortgage and you give them a mortgage. And when you do this issue of, oh, well, you know what, we'll do the mortgage first and then we'll do the protection, what you actually do is give them everything they want. And then you're wanting what you want, and it's not going to happen, or very less likely. Now, the issue you have is you get those one or two that it does happen, and we trick ourselves to go, well, it does work. If we look at the data, it won't. So they were pitching too late, and that's a big problem. And I see this a lot of people. It's too late. It's an afterthought to the mortgage. It should be anchored directly to it. What did we change within the coaching to get this? How do we reach this goal? Well, first of all, like I said, the first thing we need to do is we need to fix that sales structure, that call structure. So we added a fixed discovery and submission call format into, as well as a protection pitch within that. So what do I mean by this? Well, we had a discovery call, which is an hour long. You're going to move them to a Zoom call. So they went on a Zoom call for all calls. So every call was a Zoom call, nothing more. Those Zoom calls, they are going to be an hour discovery call and an hour submission call, meaning discovery call is when they first get in touch with you. Submission is when they found a house and you're going to submit the mortgage. And we included protection pitches in both of these points. So we introduced protection in discovery call, and we then closed protection in submission, and everything was done in the second appointment. That submission call was done and it was sent off. That is vital. So it was packaged. There was no separation between mortgage and insurance. It was the same. And it was a clear, defined, scripted process, very scripted, highly scripted, and fixing those discovery calls. And they were non-negotiable. Clients couldn't now come in and do, oh, I'm going to see at the weekend. They were fixed to the client's diary, and it was 100% tailored to them. Then the other thing we did as well on top of that is we looked at their fee confidence. So we stopped discounting, and we learned, and I taught them, we worked on actually how to communicate value with certainty. So the idea of this was that irrelevant of whether they were at the estate agency fee or not, however the lead came in, so those estate agency leads, which is, like we said, high urgency and low trust, we didn't start to dance to the beat of their drum. We onboarded them slightly different, but we stayed confident in our service and what we offer. And so I made the client make sure that when they were talking to those people, fees was a non-negotiable. There was no discounting at all. We do not discount. Now, from an income perspective, this is a big chunk of income that you can boost up. You're doing 8 mortgages a month and you're waiving half those fees. You got a £500 fee. 8 mortgages a month, you're losing £2,000 a month. That's a big amount of money. £2,000 a month over a year is 24K. That's a lot of money to your top line. You're just shaving off. But it feels like less because it's like, oh, it's just one case. Oh, it's just one other case. It's compounding. Everything I do and everything I believe in is about this law of compounding. It compounds and it gets bigger. And you want to make sure that you are not just kicking them to the side and going, oh, it doesn't matter. That case doesn't matter. Yes, it does. And it matters for a number of reasons. One of the reasons why it matters with fee confidence is it's not just it's actually less about what you make. Of course, we just talked about what you make, but it's less about what you make. It's actually about what it does to you and your own confidence, which I said about fee confidence there, is that when you discount, you're telling yourself you are worth less, which is you're worthless. And obviously I like that. But you're actually telling yourself that. Whether you like it or not, and whether you're going to be a big, strong man and go, no, that's not me, or not, truth is, it is. That's what's happening. You're telling yourself subconsciously that people will not pay that you are not worth that. And I'm not saying that from a sense of, oh, no, I know I am, because I felt that way. With coaching, as a broker, I felt the same way. It's human to feel that way. And guess what the cure is? The antidote to worried about imposter syndrome and fees and fee confidence, guess what the cure is? The antidote to it is just charging. And when one person says yes, and 2 people say yes, and 3 people say yes, you start to have a chain of events that make you go, wait a minute, they'll pay. You've got a predetermined perception of what's going to happen, and it doesn't happen that way. So with this specific client, I was like, no more fee discounting ever, at all. Blood relatives only. That's kind of my rule. Blood relatives only. No more than that. Friends and friends, they still pay. Your friends should pay. No such thing as mates rates, in my opinion. Your mates should value you more than anybody else. If your mates don't value you, why would anyone else? Just to leave that one out there. Protection first was the other thing. So we spoke about this many times. I'm going to bang on about it more. But protection, we restructured their protection pitch very early as a core part of the advice, not a bolt-on. So the idea with the protection is that we call this the mortgage package, and we anchor it all together. And so mortgage package is everything. It's all together. The one lot, all anchored together, is the mortgage and the protection and the GI. It's all part of the thing. And protection is what we do. And it is irresponsible of us to lend money to people and get people into significant debt without eliminating that risk. Because I say this all the time, with significant debt, which is what we do, comes significant risk. And if you do not eliminate that significant financial risk, it's malpractice, in my opinion. It's true. I just believe that. It's malpractice. And so what we do is make the clients aware of that. The issue with a lot of this stuff is clients will only have a problem with it if they do not understand why they should have it. But if they do understand why they should have it, they'll be absolutely fine. And most of this is an understanding issue. They don't know why they should have it. And a little trick on this is fear-mongering them into it, wanting to get cancer and all that stuff. That's not going to do it, because you're just scaring them into a decision which, once that fear goes down, they'll carry on and do what they want. That's just what happens. I had it with me in my own life. We all do that. Have a health scare, turn our life around, health scare goes away, we fall back onto where we were before. That, in our protection world, will equate to a cancellation, which will equate to a clawback if you're taking it up front. If you don't take it up front, then obviously it will equate to a cancelled drip payment, which we don't want anyway, because we want to get paid for the advice we do, which is good advice, real advice, which is what you want. So protection first. And then the other thing that we really changed when we worked together on this and looked at this was client filtering. So we built a pre-qualified system to avoid time wasters and focus on actual A-grade clients. Now, you can do this in many different ways. There's a really basic way of doing it. Just Calendly setup is how we did it. Calendly setup that just has a routing system that if they ask about 5 or 6 questions, and a series of those questions, depending on what they answered, will depend on where it sends them. If they answer and they're a hot to trot lead and they're ready to go, it gets them in this week. If they're not really hot to trot and ready to go, it gets them in the week after. So that's the availability of this week is gone. If they are not ready at all, it redirects them to a lead magnet, which will teach them what they need to do, usually deposit or credit is that case. So bad credit, bad deposit, or bad credit and no deposit. Those are the two. So there's 2 lead magnets. And we had this pre-built system. What that meant was the client is not then wasting time on people who they don't need to speak to. By the way, it doesn't mean these clients are bad. They're not bad. You just shouldn't be speaking to them when they're not ready. They're what we would call in the Mortgage Business Mastery system a passive client. A passive client is what they are. An active client is somebody who's ready. And we want to speak to active clients, and our content should be going to passive clients. We make lots of content to go to passive clients to educate them and get them ready. And our time is phased for active clients. It's exactly the same with me. There's lots of people who want to work with me who can't afford me. Something against them, I just can't give them a discovery call because I don't have enough hours in the day. So the people who can afford me and hit my criteria can have a discovery call. The people who can't can go into my content reel to get to the point where they will eventually hit these figures and we can work together. It's exactly the same. And that's exactly what you want to be doing too. So those are the things we did. We looked at those things, which was sales structure, fee confidence, protection first, and client filtering. So what was the result then of this? What was the result? So 90 days later, we've had this thing in place. What did we start to see? Well, we actually started to see a couple of things. We actually saw the same number of leads, but we actually noticed better conversions and doubled income. So same number of leads, roughly, give or take, better conversions, doubling income. Now, we were also looking a little bit at the social media. We were increasing output a little bit through socials, but the filtering system was filtering out the people who were not ready from socials, not from the introducers, because introducers are ready. They're ready to go. So the lead volume stayed the same. It probably, if I'm honest, it may have even dipped a bit, but there were significantly better conversions because the process was followed and the actual income went up. We already know the income they went to. They went 21,000. Now, obviously, that took them a few months to hit that, but that's pretty ridiculous considering that will equate to, that's an OTE, so an on-target earning for that business of £250,000, just over £250,000, which is significantly more than their original OTE, which is about 108,000, just under 110,000. So that's a significant jump, Massive jump. It's, like I said, a lot more than double. My title is misleading. But it is. That's a significant jump with very little changes. What we also noticed was an increased average case value because the protection was sold up front, as you can see on the income amount. We also noticed there was no more chasing because clients had come pre-sold. They'd gone through their pre-qualification. Their discovery call was structured. So because of that, there was no chasing on the front end. And also because we were submitting them all together, protection and insurance all together, there was no chasing on the back end because everything came in. It was a kind of two and done process. Speak to them in discovery call, ask if they want to go ahead. Yes, they do. Move forward, submit, done. Then it was just progression after that point. Just pretty light touch. So they actually, result of that was they had more time. There's more time. There's less stress. They're in more control. And so, yes, they actually had the same number of leads. They had better conversions. They had a significantly increased income. But guess what? They actually worked less. Who doesn't want this, by the way? This is not me trying to pitch to you and sell you. I don't even have space to work with me. I am telling you this because it's important to get this anchored down as to what the things you can do. What are those things? The key lesson for you guys to take away is that structure beats speed. So you don't want to rush through your calls. You want to guide them properly. It is so important. If you are trying to rush through because you think I've got to get to the next call, the next call, the next call, you're a volume monkey. You're just constantly going. You do not want that. Structure is going to beat speed every single day. It is this concept I love, which is, I think it's a Marines concept, which is what's slow is smooth and what's smooth is fast. So if you start slow, you'll get good, you can get smooth, and if it's smooth, you can make it faster. That is exactly what we need to focus on here. The other thing with the key lesson for this and the key takeaway was protection isn't optional. It's a revenue stream and a client service, and it is your duty as a mortgage advisor to significantly reduce their risk or eliminate where possible. It's not optional. And the client knows that and feels that when you know that and you feel that. And that is a huge, huge milestone. That alone, structure and protection, is going to just significantly improve your income and improve your overall lifestyle or cash flow to your business. Third point to talk about is consistency compounds. This is especially important within your calls and everything you do. If you are consistent with how you follow through on things, if you're consistent with your methods, guess what? You start to learn what works, and more importantly, you start to learn what doesn't. You are consistent with how you show up in your marketing. You're consistent in how you show up in your calls. You're consistent with how you deal with clients. You're consistent in how you pitch your protection. You're consistent in how you charge your fees. You're consistent across the board. If you're consistent, then you can make tweaks to improve. If you're not consistent, it's literally like throwing darts at a dartboard with your eyes closed or blindfolded. You have no idea. And that is so vital to get into your heads with this. Big takeaway when you take away this is your time is your margin, okay? Pre-qualify, automate, delegate wherever possible, but you need to make sure that you're protecting your time and focusing on how that time is used correctly. If you are just throwing that time out for anybody and everybody because you think they're good, then you are wasting income, because there are three income sources. There is time, money, and goodwill. And guess what? Time and goodwill are tax efficient. There's tax free, in fact. This is what we always focus on. We always focus on money, but there's more than that. We want to get them right. All three of them in line. We will be rich, quote, rich, if we have all three of those things. And it's very important that we look at that. Do not be a busy fool. And yet so many advisors do that. So what should you be doing right now? What should you do if you're an advisor right now and you want to take action on this stuff? How would I advise you? This is what I'd recommend you do. Look at your last 10 calls. So audit your last 10 calls. And is there a clear structure? And you want to look for these kind of things with it. So one, are you leading the client journey or are you following the client's pace? So are you actually guiding them down a journey that you want them, a cleared, predetermined journey you want them to go down? Or are you just going, yep, and you're just order taking? That's really important. The second thing is, how often are you actually talking about protection before the mortgage offer? How often are you actually mentioning it? Are you mentioning discovery call, submission call? How in depth are you mentioning it? Watch these calls. You should be recording your calls wherever possible, in my opinion. It's like game tape. You should be doing that. How often are you mentioning it? If at all. Because if you're not, there's your income straight away. And then the other thing is, what is your fee confidence? Do you discount or do you anchor to real value? Are you discounting your fees? Are you waiving them completely? Are you negotiating and discounting them without the client even talking about it? Just look at how you react when you mention money and fees. Just go and have a look. Those are the things. Audit those three things in the last 10 calls. You're going to get a clear idea of what it is you're doing right, and more importantly, what you're doing wrong. And hopefully then, having listened to this episode, you make some changes and you start to see some results from this, because it is possible. You see the difference in this specific client where they went from £9,000 a month to £21,000 per month, which seems crazy, but it's not. With the same level of business, the difference wasn't more leads, it was better processes, and that's what scales income, better processes.